Good afternoon, everybody. We're going to wait a few minutes to let people join. And while we're doing that, does anybody have any opens? All right. Over the next 5 or 6 weeks, I hope you guys really enjoy what we have lined up. We have a series of guest speakers that are going to be speaking to us on the topic of self-directed 401ks and self-directed IRAs. And so they come each from a different company that are doing a slightly different thing, and I'm working with them to make sure that they don't repeat the same content. But over the next 5 or so sessions, we should have a pretty good understanding from a couple of different points of views of self-directed IRAs and how to leverage them. I would love it if you guys would take this meeting request and forward it to anybody else who might be interested in self-directed IRAs. Getting guest speakers in is a definite time commitment on their part, and I want to make sure that we have enough people in our group in order to do that. So I'm really relying on you guys to forward those messages. I'm not forwarding as many of them myself just because it seems self-serving. But if you guys are finding value in this, and if you think other people would find value in self-directed IRAs or 401ks, feel free to send the meeting on.
Can you talk a little bit about the Yammer? What is that?
So
we've been able to have that, make that work.
That's right. You didn't have access to Yammer.
I don't even know what it is.
Okay. So has anybody else on the line used Yammer much?
A little bit.
A little bit? Do you want to mention anything about it? Can you guys hear us? I don't hear anybody on the bridge.
Michelle's online. I
Okay.
couldn't access it either.
Really? I thought it was available company-wide.
I can get to it, but I have my group uses Yammer too.
Yeah, I think we've got about 10 people signed up in the Yammer group right now.
It's very big in IAGS. I know
Right.
Roger's been heavily hyping it in his QGS meetings and been commenting, blogging on it almost daily.
Okay.
So I know it's big on some parts of Intel. I don't know if it's...
Okay. Well,
I think it's still in the early days.
Yeah. From what I understand of it, Yammer is basically a private social network.
Yes,
it's kind of a Facebook clone.
Facebook for corporates, yes.
Facebook for corporates. So I actually haven't seen any way to set up appointments or meetings on Yammer. So it does, as far as I can tell, it lacks that.
Yeah,
but I'm new to it also.
Microsoft Teams may be the vehicle for that.
Okay, so Microsoft Teams can set up appointments on Yammer?
I don't know. So there's various components of the Microsoft Office suite that are being talked about by IT. So we've got the Office 365 where everything's in the cloud now.
Okay.
And then Teams where we can collaborate on a team-wide, and then Yammer for the social corporate messaging. Lastly, just allows people to get instant feedback to senior management.
Sure.
It's very similar to Skype, and it's going to be rolled out by the end of the year.
Good. Company-wide?
Yes.
Okay. Well, maybe the answer then is just sit tight and hopefully you'll get access to it. Yeah, it seems like a good way to communicate with people. So I set up a channel there, and hopefully, it's just another way that we can all stay in touch with each other. I'm kind of surprised that our guest speaker hasn't joined yet.
Do you have a number for him?
I do have a number for him. Let me go ahead and give him a call. While we are all waiting too, I would like to say that that I would love to set up one-on-ones with any of you if you want to talk about anything related to real estate. I'm very interested in getting to know everyone here. As you all know, I do apartment syndications, so that's my main strategy for building wealth. And I'm always looking for investor partners. And so I actually am prevented, since I'm fully SEC compliant, I can't generally advertise the deals that are currently underway. But if you're interested in those or getting any information on those, we can set up one-on-ones. So if you're interested in that, send something to my calendar, and I'm actively looking at the moment. All right, let me see if I can give our guest speaker a call. Do you know how to conference somebody in? This?
Gonna go no.
Okay.
And I'm sure there's a
I don't either.
that button there. Do you want to try it?
Yeah, go ahead.
Just the upper right corner, it has a plus people box. And are you guys talking about the room phone? I don't know.
Yeah, that's true. I can. Did we lose everybody on the line, or are you guys still there?
We're still here.
All right. Well, maybe what I can do while we're filling some of the time here is talk to you a little bit about some of the people that we have lined up. So next week, which is the day after Thanksgiving, of course, we're not having any meeting, so there's nobody lined up then. Today, our guest is Chris Tanner, who is a business and development manager at the New Direction Trust Company. Prior to that, he owned a company that provided self-directed 401k services. Chris personally self-directs his retirement plans since 2006, and during that time, he's invested in real estate properties, real estate mortgages, tax liens, and other real estate-related items. So he has a lot of practical world knowledge in organizing his own self-directed IRA, as well as owning a company that helps other people do it. And hopefully we can get him on the line. I think I'm going to start asking attendees to show up at least 15 minutes early, because this is the second time this has happened. All right, and then after that, we have Scott, and this would be on December 6th. We have Scott Martyr, and Scott works with Advanta IRA. He's been there since 2006. He is their Director of Business Development. Advanta IRA works in self-directed IRAs, as well as assisting clients with investments using their self-directed IRA. He's very familiar with the process involved for these types of investments, and is also a licensed attorney, having graduated from the University of Florida School of Law. So he'll be on the 6th. And after that, we actually have a really interesting guest. This guest is not about self-directed IRAs, but he is the owner of a company called Property Radar. And Property Radar is a website that does deep data analysis on neighborhoods. And so his marketing value is that he can help you do a hyper-local analysis of a particular area, and not only drill into the city, but within the particular area of the city, on the block of the city. And so he is very into data and data analytics, and taking in thousands of data points and trying to come up with the best places to invest in based on that. So he owns this property company, Property Radar, and is going to be sharing how he does his hypersensitive regional analysis, or neighborhood analysis. And that is on December 13th. All right, and the next two meetings, December 20th and 27th. I think everybody's okay with canceling. Yeah. All right. And then lined up in the new year, we have two people so far. The first of these is Justin Richards, and Justin Richards is also a real estate syndicator. He, however, specializes in the tax advantages of real estate syndication. And so he's going to go through, normally when you're talking about tax advantages, there's different types of income that the IRS specifies. So there's earned income, there's passive income, there's capital gains income. And normally you can only deduct, one type of income you can only take deductions in, say, earned income from your income. You have to have the types of income matching. So if you have earned income and you have deductions in earned income, you can match the two of them. If you have passive income and you have depreciation from passive income, you can match those two. But he's going to talk about different ways that you can actually cross match, so that if you have depreciation in properties, you could actually use that to bring down your earned income taxes. So he'll talk about strategies of doing that and what the tax advantages are of investing in depreciating assets, as opposed to your car, which is also a depreciating asset. You just don't get a write-off for it. And then towards the end of January, we have lined up a CPA and founder of 401kcheckbook.com, which gives investors direct control of their tax-sheltered funds for real estate, equity, and debt opportunities using checkbook controls and solo 401ks, checkbook life, as well as checkbook life insurance. So he's going to come in and talk about his organization, which helps people use their 401ks and to invest and borrow against and to make investments through their 401ks in a self-directed manner. So I'm looking forward to hearing from him as well. He's from reassurefinancial.com and 401kcheckbook.com. So, yeah, so we have quite a number of people that are signed up to come and speak to us, if they show up.
Did you send a text to that guy?
I did not send a text to him yet, actually. Too busy spouting. Does anybody else have any questions, opens, thoughts, topics they want to talk about?
There's so much. It's hard to use your 401k money. Do you have to leave the company? To create
I would
IRA?
I would wait till they come and ask them that.
Yeah, through penalties. That made the question right.
Right.
I don't know if anybody answered that question in the room, but you can't, Intel and Fidelity will not allow you to reference your 401k money into a self-directed IRA until you leave the company, unless you.
Yeah.
Yeah.
Yeah, that's what I did. I mean, when I left, I took that money and created a self-directed. It was they really didn't want to part with it. It took a little while to extract it from their hands. But I finally did.
Well, are there any other topics that I know that Airbnb is on the list. At some point, too, I suppose I'll probably give a talk on just the business model of real estate syndication, which I know you got some of that from Ravi, but I wasn't there. I didn't actually hear his talk, so I can give my own version of it. Are there any other topics that people want to hear about?
I think I mentioned this one already, but apartments, multi-unit.
Yeah, multi-unit. Now you were talking about. Okay, our speaker just messaged me. He says he's trying to access it, but the link is not working. Okay, so I'm going to try and troubleshoot him with that, and hopefully he'll be online.
Well, can we get that person in again?
Yeah.
Can he just call in the bridge?
Well, that's what he's trying to do.
I've got his presentation, so I could share his presentation.
Yeah.
Hear from other people? Hi, did we get the rest of the group back?
Yes, you just came
Yep.
back online.
Okay, and Chris, are you there as well?
I am, yeah, you bet.
All right. You sent me your presentation, so let me pull it up.
Okay.
And while I'm doing that, give me one quick second to do that, and then I'll introduce you to the group.
Perfect.
Although I
Sounds great.
actually did read your bio to the group already, but I'll do it again now that you're here.
Okay. Perfect.
Okay. All right, I'm sharing my desktop to the group, and I've got your presentation ready. I'm going to download it really quickly and then jump over to your bio.
And I apologize, I didn't catch your name at the beginning.
I'm sorry, my name is Daniel Homland. We've got about 10 people on the line right now. And so it's a little bit of a smaller group, but we're all anxious to hear about self-directed IRAs. And let me pull up your intro here. So Chris Tanner, the bio that I have here, he is the business development manager at New Direction Trust Company. And prior to that, he owned a company that provided a self-directed 401k plans. Chris has personally self-directed his retirement since 2006, and during that time he's invested in rental properties, real estate mortgages, tax liens, and other investments. Chris brings a real-world practical knowledge to the table as a result of self-directing his own retirement funds and assisting hundreds of clients with their self-directed retirement plans. So we actually got all the business meeting information and tasks done ahead of time, so I'll just turn the floor over to you, Chris.
All right. Well, Daniel, thank you so much, and thanks for having me today. And so, Daniel, I guess you can control the slides and advancing those for me?
Yes, I'm on. Just give me a slide number if you have your slides in front of you, and I'll go there.
Yeah, you bet. So we'll just go to the second slide, if that's okay with you.
Disclaimer?
Yep. And so we always have to start off here, and I had to throw in a little bit of information for Intel. But first of all, thanks. Glad people could join us today. And my goal really today was to provide kind of a generic overview, but then offer a little bit of time and opportunity for specific questions. Just not knowing what everyone's background is, and hopefully this isn't too generic or too basic. But I did want to leave a little bit of time for specific questions as well. But at the end of the day, I do work for a company that we're basically a custodian, and so we're kind of a glorified bank. We don't offer investment advice. We don't endorse any products or anything like that. So today this is strictly for educational purposes, and of course, Intel is not representative of any of the information today. So the next slide, we're just going to talk a little bit about, well, what is a self-directed IRA? And it's interesting, when people call in, a lot of our accounts are opened online, and when they get there, one of the questions they're asked is, what kind of an account do you want to open? And we'll get calls, and it says, I'm looking for self-directed, and I'm not seeing that as an account option. So it sounds kind of silly, but self-directed is not an account type. It's really just a descriptive term. It's more of a marketing term for, I guess, the way that an IRA can be used. And so the big difference, obviously, with a truly self-directed IRA is it is a type of retirement plan that allows you to buy, we'll just call them non-traditional assets. And since this is the real estate investor group, obviously, there's a lot of different ways you can use retirement funds, whether it's buying property directly or lending money based on real estate. But just know, and if we flip forward to the next slide,
All right.
that self-directed retirement plans, believe it or not, these have been around for almost 40 years. The rules that enacted IRAs and 401ks have been around since 1974. And so it's always interesting, if you've never heard of this concept or this idea, people are wondering, well, why haven't I heard about self-directed retirement plans? And the primary reason is that your traditional brokerages that are responsible for the vast majority of retirement plans, whether that be 401ks or IRAs, they offer traditional securities, stocks, bonds, and mutual funds, and they're really only set up to sell those kinds of securities. And so because they're not set up to set up retirement plans that allow you to buy real estate, obviously they're not going to promote or market that. In fact, they don't have an interest in promoting or marketing it, because that means you're going to take your money away from them and you're going to go, self-direct your own retirement plan, but maybe buying real estate or whatever you choose to buy. So at the end of the day, it has to do with, the big Wall Street brokerages. They control the vast, vast majority of the retirement funds that are out there. And the estimates are just IRA plans alone. You've got in the neighborhood of 8 trillion with a T, in money out there in these different retirement plans. And a very, very, very small percentage are truly self-directed. But the bottom line is that although you don't hear about them, these have been around for a long time, and the IRS certainly allows for quite a broad range of investment opportunities. And so the next slide talks about the different kinds of plans that can be self-directed. Now, we always hear about self-directed IRAs, and there are certainly different kinds of IRAs that can be self-directed. And we kind of break this into 2 categories. There are employer accounts, and so if somebody happens to own a small business, these are the kind of accounts that you could open a self-directed plan for. So it could be a simple or a SEP IRA, and then we also have self-directed 401k plans. But then on the individual side, you can have either a traditional or Roth IRA, and then something that's actually growing in popularity now are HSA accounts. And interestingly, and I don't know if Intel offers HSA options through their company plans, but if they do, those accounts can be self-directed and invested just like an IRA plan can be, invested, so to speak. And those are actually growing in popularity as I think more and more insurance companies are towards those high deductible health plans. But if you have an HSA account, just know that, just like an IRA, it can be used and invested just like an IRA plan. So the next slide.
Is interesting. I was going to say, I think quite a few of us do have HSAs here.
But they've just switched to penalties, so.
Oh, and they've just switched. Okay.
Oh, they did. Well, what I would say is, if people have an HSA account, of course, even though that may have switched, the HSA account doesn't go away because it does belong to you as an individual. Certainly, if people have more questions like, well, how would that work? We'd certainly be happy to connect at some point. But just know that HSA account, if there's money still there, it belongs to you as an individual, just like an IRA plan, and so you still would have the freedom to move that account and use it the way you'd like. So, okay, on the next slide, the idea here is that, especially if somebody's not familiar with the idea of a self-directed retirement plan, we're not, we don't do any financial advising. We don't offer any kind of investment opportunities for our clients. And so the bottom line is people are 100% responsible for, number one, picking the investment that they want to invest in, but then number two, we don't do any due diligence from a standpoint of, we don't make sure that the investment's legitimate. We don't do any verification of it's, going to be a good investment or not. That's really up to the individual. And so self-directing is 100% up to you as an individual to make those decisions. Number one, what am I going to invest in? Number two, to evaluate everything about the investment. Is it safe? Is it going to provide a good rate of return? All those questions that come up. And so if somebody opens a self-directed retirement account, really the money just sits here until people, somebody tells us what they want to have, how they want to invest those funds, basically. And so the next slide.
Possible IRA investments.
Yep. It's almost easier to talk about what you cannot invest in as opposed to what you can invest in. And so there's a couple of generic categories of things you cannot invest in with your IRA plan, and one of those is collectibles. So collectibles could be, art, pieces of jewelry, or old antique cars, things like that. The IRS says you cannot invest in those. The other thing is the IRS says you cannot invest in life insurance. But outside of that, it's almost unlimited what you can invest in. So obviously here are some examples. People definitely do invest in precious metals. And when we say precious metals, mostly individuals with these kind of accounts, they're buying actual physical metals that are being stored in a depository. So not buying like exchange traded funds or anything that just tracks the price. So it's physical metals that most people are buying. You can invest, obviously, still in stocks, bonds, mutual funds. So even though it's a self-directed account, we definitely have clients that still invest in those things in addition to real estate and precious metals. So just to be clear, all those options are available to you. What the self-directed plans do is they open up more options. And so if you did want to buy real estate, like a physical property that would be owned in the IRA, you could certainly do that. But just to give you an idea, if your mind can imagine it, it probably can be done. And so on the next slide, just wanted to give, ways to participate in an asset. Okay. And just wanted to give you, a little bit of a feel for, how are things invested in and how do people purchase things from within this account. And obviously the most straightforward way is that an IRA can actually own a thing. And so it can literally own a piece of real estate, or it literally can own a bar of gold. So it can own something outright. But the other thing that the IRA can do is it can partner. And so I'm going to go into some examples here in just a little bit. But keep in mind that your IRA doesn't necessarily have to buy 100% of an asset. It can actually own a piece of an asset. The other thing that's interesting is that the IRA can essentially be a lender. And so when an IRA is lending, it could be a secured loan or a non-secured loan. And so from our perspective as a custodian, really all we're looking for is if you come to us and say, I want to loan money, we look for very basic parameters. There does need to be a written agreement. There needs to be a stated, amount being borrowed, an interest rate, a repayment schedule. But as long as there's some basic parameters in place, your IRA can loan money either to an individual or an entity. And then the other way that we see IRAs participate is as an equity partner. And so you may not actually own an asset, but you're owning maybe shares in a company. And we see this quite frequently with private companies or startup companies, where the IRA can actually buy ownership via a stock interest or even just a partial percentage of the equity, so to speak. And so go ahead.
I was going to ask, I think I've heard that when you invest in real estate, some of the tax advantages may not be there if you invest in your IRA as opposed to just investing directly. Can you speak to that at all?
Yeah, absolutely. So let's talk first of all, if you bought, let's just say like a piece of rental real estate, and let's say you put some money down and so you have a mortgage and it's a rental property, it's producing income. Well, when that happens, you have some things that you can write off. And so some of the write-offs include depreciation, any expenses that come up with the property. So expenses could include, if you have a property manager, there may be an expense there, taxes, insurance, interest expense. So if you have a mortgage and you're paying interest, obviously that's an expense to that rental property. And you're correct. On the other side, within a retirement plan, basically what the IRS is saying is that you don't get the best of both worlds. On the personal side, you do get the expenses, but if there's any income coming in, you may be taxed on that income. The reverse is true with a retirement plan. If you buy a property and you can use a mortgage, those expenses go away. And the reason they go away is the IRS is saying, well, your income that's coming in is either tax-free if you happen to be running that rental through a Roth IRA, a Roth 401k, or an HSA, or it's tax-deferred. So we're not taxing you immediately on the income, but you don't get to write those expenses off either. And so if there's mortgage interest, if there's, property management, whatever those expenses happen to be, no writing it off from the rental, the retirement plan side, so to speak.
And I assume the same rules probably hold true for private equity. If you have private equity that sends you a 401k with depreciation, that those are no longer eligible for tax write-offs as well?
Yeah, correct.
Okay.
And so what I would say is, if your primary goal, like let's say you have a high income job and you need the depreciation, you need that offset, then this may not be a good option. If that's your goal and that's what you're looking to do. On the other hand, as an example, I happen to own a rental property in a Roth IRA, and the numbers are such that the cash flow that's being produced from there, and knowing it's in a Roth IRA, it'll never be taxed. I'm perfectly happy not having the depreciation or anything like that. It's still a good investment for me. Plus, there's been significant appreciation. And so the neat thing in the rental, in that setup is, I would say, and it happens to be in Colorado, and I don't know where all you guys are located, but I'm guessing California. If the appreciation's been anything like it has been here, it's worth about 4 times what I bought it for. So if I wanted to, I could sell it and I capture all that gain tax-free. And so that's one place where the retirement plan has a significant advantage. I don't have to do a 1031 exchange, or if I sell it, I don't have any taxes on the capital gains that might come from the sale of the property. And so if I wanted to, I could go ahead and sell it, and all that gain is tax-free to me. So just kind of laying out some examples of things that can be done with those retirement plans. Under the guise of a rental property, you can have a more traditional rental where you have long-term tenants in a rental property. But we've seen quite a few clients, and this has been more popular recently, do Airbnbs. And so it's still technically a rental. It's just shorter term rentals, or kind of in between the Airbnb and full-time, a vacation rental, or maybe they're renting it weeks or maybe even a month or months at a time. We kind of talked about the fact that you can lend, but another way that we see people invest in real estate indirectly is by purchasing tax liens or tax deeds. And partial ownership. This one's an interesting one, and I had alluded to earlier the fact that you could do partial ownership. And so something that we'll see here quite frequently is somebody has some money on the personal side and some money in the retirement plan that they want to buy maybe a piece of real estate. Just know that it's possible to partner your IRA with your personal funds or somebody else's funds to purchase something. The one thing I would caution there is that because the IRA is a partial owner, there's some IRS guidelines that you just want to be aware of. So as an example, if, for example, we wanted to buy a property 50-50, and so half the money comes from me personally, the other half from my retirement plan, all income and expenses need to be shared 50-50. And I did want to point out and mention that even though we're purchasing with retirement funds, if we were wanting to purchase a piece of real estate, it is still possible to use debt to make that purchase. So you don't need 100% of the purchase price to make the purchase. It is possible for your IRA to actually borrow money and carry a mortgage just like you may do on your personal side. And then, of course, I use a generic term, syndications, but this is really where maybe your IRA or your 401k that's self-directed isn't buying that property directly, but maybe it's participating in a group. And so I know we have a lot of people who buy into apartment deals where there's a general partner, there's another company actually buying the apartment, and they're just a limited partner. They're buying a small piece of that apartment, so to speak. And so flipping to the next slide.
Why self-directed?
Yep. And we're going to talk about why self-direct. In the next slide, we're going to talk about why you may not want to self-direct. But I would say the number one reason people even look at self-directing is the idea of control. And the way I would say it is, with most traditional retirement plans, you typically are offered a basket of options. And the options, and 401k plans in particular, so you may have like a target date 2030 fund, or you may have the option to buy specific mutual funds, but you don't have the control to really invest that money in anything you want to. So you first of all only have the option to select that basket of offerings that you're given. And the idea of control also is that, for example, if we buy stock in a company, and we'll just throw one out, maybe it's Apple, you can buy Apple stock. At the end of the day, you don't have a lot of control over what Apple stock does, whether it's going up or down or not changing much. Whereas if you're buying a piece of real estate, as an example, you get to pick the property, you get to pick the price you're going to offer, you get to pick the neighborhood. If it's a rental property, you get to decide what the rent is, you get to decide if you want to make upgrades to the property, you get to decide who the tenants are, you get to decide all those things. You have more direct control of the actual investment. And then freedom, really, this really opens up a wide variety of opportunity and things that you can invest in. And we kind of touch on it indirectly, returns, that's up to you. We've seen clients that are wildly successful and are very good self-directing, and we've seen clients that have not done very well. And so you can make money and lose money with these accounts just like you can any other retirement plan. And then I think more importantly, the last thing is the idea of diversification. And I think we've been trained through the financial system that the idea of a traditional retirement plan diversification is to own a lot of different securities, a lot of different stocks. And so that is I guess would say a type of diversification. So if one company goes bad, it doesn't spoil your whole portfolio. But the kind of diversification you can get involved in with a self-directed plan is that you can get into what I would consider to be non-correlated assets. And so if 100% of your retirement plan is sitting in things that are really tied to the market and how the market is doing, it might be nice to have it invested in things that are not correlated or tied to the performance of the market. And so if you have a rental property with a solid tenant, if the market goes down, you're still collecting your rents. You're still making your money. It doesn't matter if the market's going down. So as long as you're in those types of assets, it gives you some protection against the possibility of the market fluctuations that we see. And then on the next slide.
Why not self-direct?
Yeah. The truth of the matter is that this is not for everyone. And, if you've never, ever even thought about or have any idea, like, okay, I have a self-directed plan, but I've not invested in anything or done anything like this, there might be an inexperience factor where, gosh, I've never bought rental property, or I've never really invested outside of stocks, bonds, and mutual funds, and there's just not a comfort level there. And so, let's be honest, if you're not comfortable and it's not your area of expertise, it may not be a good fit for you. But on the other hand, what we find is there are a lot of clients who are already buying real estate, investing in non-traditional assets, and they're really just doing what they're already comfortable and familiar with. Now they're just using retirement funds to do the same thing they're doing anyway on a personal side. Another reason why people will choose not to self-direct is that there are some IRS rules around what you can and cannot do, and then also who you can invest with. And so we're going to get into that just a little bit here in a bit. But sometimes those rules, people just don't like them. And so it's not a good fit for them. And I would just say, this, at the end of the day, I think these plans require a little more work from the standpoint of, if you open an account and you put money in a self-directed account, the money just sits there. And I mean, it's an active participation. You have to decide, what am I going to invest this in? What makes sense for me? And if you're not that kind of person that's proactive and willing to go get that done, probably not a good fit. If you would prefer to have a financial advisor or that kind of a setup where they kind of choose the investments, pick things for you, that's probably a better fit. And so
just a
it's
comment,
fit for some, but not
from
all.
Bridge.
Sure.
So this is Richard McGrew. Just the IRS rules are quite important. I know you're going to go through that, but just in case anybody's planning to drop before the end of their lunch period, those IRS rules can make you lose your entire IRA if you don't do things properly. So make sure you pay attention to the rules when he walks us through those. It's very, very penalizing if we make a mistake with the self-directed IRA.
It is. And one of the things that I would mention is that this is why it's always a good idea to have a conversation with a good custodian, is that one of the things I like to point out is IRAs and 401ks have a different set of rules. And so just to kind of plant the seed, I know a lot of people were familiar with the idea of a self-directed IRA, but know that there are self-directed 401k plans out there where you can accomplish the same goals, but the penalties aren't as severe. And so in a 401k, for example, if you did make a mistake, the penalty is a 15% excise tax on that specific investment. Whereas in IRA plans, one mistake in there could blow up the whole IRA. And what that means is that the IRS has the right to distribute it, and it's a taxable event. And so those IRS rules, you just definitely want to pay attention to them, no doubt about it. So in the next slide,
no self-dealing?
Yeah, here's some of those rules, and just so people have an understanding or an idea that the IRS does have rules about who you can invest with. And so one of the people that you got to be careful that you are dealing with, and this sounds odd, is yourself. And so you're what's known as a disqualified person. You and your IRA are two separate entities. And so you want to be very careful that you're not doing anything where you're commingling your retirement funds with what you're doing personally. So let me just give a quick example of where this comes up, especially in real estate. You couldn't go out, use your retirement funds to go buy a piece of real estate, and let's say that real estate, the intention is to fix and flip it. If you were to go out and do the work on that property, like you're in there painting, doing some of the demo work or whatever, the IRS is basically saying you're not allowed to do that. Another example would be is if you bought a rental property and at some point in time you were like, well, you know what, it might be cheaper for me to live in my rental property. Maybe I'll sell my personal residence and I'll just live in this property that my IRA purchased. Unfortunately, that's a personal benefit. You can't live in a property that your IRA owns. And that's just an example of the self-dealing. And so on the next slide, it talks about disqualified persons.
Yeah, who are the other disqualified persons?
Yep.
Okay. Oh,
so very quickly, and then so hopefully in the slide, but basically it's direct blood lineal family members. So you, your spouse, mom, dad, grandma, grandpa, sons, daughters, or son-in-laws, and then it extends down, depending on your age, if you have grandchildren. So certain family members are disqualified. More distant family members are not. So siblings, aunts, uncles, cousins are okay.
But what does the IRS think about investing in a company in which you are, on the board of directors, or a company that you own?
So there's some specific rules and guidelines about companies that you're involved with. So one of the rules regarding ownership, there's a 50% rule. And so what that means is if you owned a business 100% as an example, that business would be disqualified from your retirement plan. But if you were a minority owner in the business, you might be perfectly fine investing in that business. Without getting into the weeds, there's kind of some rules and criteria and some things. We have kind of a 6 checkpoint that we would go through to test to see if it would meet the IRS guidelines. But if you're in a position, there's a couple things that are key, is that there does need to be minority ownership in order for your retirement plan to invest in a company that you're part of. And the other is that you would not be able to hold a position of authority where you have direct influence on decisions from within the company. So if you hold a title like CEO, general partner, CFO, some of those types of titles, then it would be prohibited.
Gotcha.
So
talk to your attorney, right?
Yep. Check with your attorney or call any custodian. Typically, the way that conversation goes is, tell me about your company, tell me about your role within the company, and the questions we'd kind of just start off with, well, how much of the company do you own? And if you own 50% or less, we kind of keep going, and we just kind of go through these questions to make sure if it's a fit or not.
Just so you know, we have about 7 or so minutes left.
Okay. We're basically kind of wrapping up, and so let's zip through the last couple of slides.
All right.
The next slide just says, the IRA. The idea here is that your IRA is a separate entity from you as an individual. So if your IRA buys something and owns something, the expenses and the income that it buys need to stay within the IRA plan. And so, for example, if your IRA bought a rental property, you can't collect the rents personally and take those rents as income to you personally. The money needs to stay in the IRA. And the next slide just talks about how does money get into an account, and it's pretty straightforward. A self-directed IRA can be funded from an existing IRA that you already have, or possibly an old 401k employer plan. And then, of course, you can make contributions into that plan. And so with that being said, let's actually skip to the last slide where there's just some contact information. So if there were any questions that came up while we were talking, we'll just leave a couple of minutes here if anybody has any questions.
Presumably you can have multiple accounts, right? So you could have an existing 401k and a self-directed IRA as well, right?
Yeah, that's right. And the IRS says there are really no guidelines. So you could, for example, have 2 Roth IRAs, and we see this frequently, or 2 traditional IRAs. The only thing to be aware of is the contribution limits apply. So you can't, for example, if you have a 401k at work that you maximize, and then you also have a self-directed 401k, it doesn't mean that your 401k contribution for the year doubles. You know, you still have caps on those, but there's no limits in as far as how many accounts that you have.
I know definitely here at Intel there are strong opinions one way or the other on cryptocurrencies. Do people own cryptocurrencies in their self-directed IRAs?
They do. Yep, that's certainly an investment that is allowed. One thing that we have learned and we have found, and it's not from our site so much, but and I'm not an expert in crypto, but the exchanges have a difficult time dealing with an IRA as an entity. They're not quite sure how to categorize it and classify it. So if anyone is interested in cryptocurrency, what we've found and what we've learned, and this has more to do with the exchanges, is that you can establish an LLC or an entity that they are familiar working with. And what happens is it's set up so that your IRA owns the LLC. So it's really your retirement plan making the investment in cryptocurrency, but to the exchange, it's an LLC. And it's just an entity they're more familiar dealing with. But the bottom line is you certainly can invest in cryptocurrencies using retirement funds.
All right, any other questions on the line? All right, Chris, we'd like to thank you so much for coming and sharing a bit of your information and your knowledge with us. And we've got your contact information here. It's being displayed for everybody. So if you guys are interested in following up with Chris, you can check him out at New Direction Trust Company. Chris, thank you very much.
Yeah, thank you.
Yeah, thank you. Daniel, appreciate the opportunity. I hope everyone has a happy Thanksgiving.
One other thing, too. I don't think I ever talked to you about this, but we were recording this, and I wanted to make sure you were okay with that. If not, I can delete the recording.
No, that's totally fine. I think we were very benign in what we talked about today, so that's totally fine.
All right, thank you. Bye-bye.
Have a good one. Bye-bye.
Thanks, Daniel.
All right.
I was 1 o'clock or something, but I have to take notes.
All right. Does anybody else have anything to say? People are dropping off, so I'm assuming no. All right. We'll see you all again not next week, in 2 weeks.